Let's talk about how to create investing goals. This is probably one of the most overlooked aspects that all traders just dismiss. I did the same exact thing early on, and it's a giant mistake because you do not realize how powerful it is to even take a few hours to create a roadmap. So we're going to do exactly that right now. What's up, everybody? Erik here. Welcome back to All Outliers. A big shout out to the YouTube members and the Patreon folks. If you're interested in joining and supporting, you can find the links in the description below. And with that, let's get right to it. So the very first thing, there's going to be 5 steps here. And at the end, the 5th step is going to walk us through some of the best practices that I've learned both from my personal experience, but then also observing other people in their natural habitat working on these kinds of things. So the very first one is one I reference all the time. This is from Stephen Covey's 7 Habits of Highly Successful People. Begin with the end in mind. This is in the Marine Corps what we would call the desired end state. What are we trying to do? And most commonly, it's some derivative of this. Replace my income. People attempt to use investing and trading as a source of income so that they do not or are not forced to work at a 9-to-5 regular job. Okay, got that one pretty easy. The next step is we now need to take that end state, replacing our income, and we need to project it out in time, and then we need to quantify things. So these are the questions you have to ask yourself. When are you attempting to replace your income with your investing income? How much is your current income, aka how much investing income do you need? What are your expenses and what are your margins? This isn't necessarily used directly in these formulas I'm going to share in a little bit, but it is more going to be a thing we want to track because that's going to be one of the most impactful early levers you can pull on to get your desired outcome. And then the last one is your future income preferences. This one is super important because a lot of people, when they're talking about this kind of planning, they tend to be super conservative. They'll say things like, oh, I just want this, or I just want that. And maybe you do, but maybe you don't. Who's to say that the right retirement for you is just bare bones, as little as you possibly need, but then you can't take vacations. You can't buy that fun car that you want to get. For me, I definitely am far more interested in fat fire. Financial independence, retire early is the fire part, but fat means you have a lot of money. It means you get to do things. So that's the very first juncture you're going to run up to here. Do you want to be fat, meaning have a lot of money? If so, there's obviously burdens that come with that. You're going to have to figure out how to make more money, save more money, and you're probably going to have a slightly longer runway unless you hit it big, which is okay. But you have to identify truly for yourself what kind of retirement you prefer. If it's what we would call a lean fire, exactly what it sounds like. It's essentially financial independence, retire early, but lean. You do it by cutting costs, living a frugal life. And a lot of people are super fulfilled in doing that. You got to pick what's right for you. I definitely prefer fat fire, but plenty of people do and live completely fulfilled lives on lean fire. You got to figure out what this is because it's a huge planning factor. Okay, so we got the first 2 steps. What is the current state? In the Marine Corps, we would call this the orientation. We want to know where we're at right now. So what's your liquid net worth? This is a super important question because this essentially becomes your investable income. This is your principal that we can invest. So when I'm thinking about liquid net worth, I'm talking about money you can invest, not all of the cash you have, because you're going to want some of that for emergency expenses and things like that. So liquid net worth in this context, I'm referring to the principal that you can invest. Next is your income, because this is going to tie into this later on, aka how much do you make now? How can we grow that? And how much of it can we keep? And then the last one, this is another source of income for traders, which is your investing performance. In my opinion, I think you need to have at the very bare minimum, ultra minimum, a 5-year runway of how you've done over the past 5 years, with the objective being that in the more recent years on that you're starting to get more consistent. That part is super important because if you have a 5-year trading history and it's all over the place, you can't really plan off of that. So that's why having a 5-year minimum, and if you get out of the gate running well, your first year is whatever, second year you're starting to get your feet under you, and then the next 3 years are pretty bang on the mark with what you're trying to do, perfect. Most people, it's going to be more than that. But the reason why I say 5-year minimum is because it typically will give you enough looks at different markets to have a pretty fair idea. But one of the things is if you are going through your planning cycle, and let's say you did it in 2012, when we went through literally a 10-year bull market, that's kind of difficult because you don't know how you're going to fare in a bear market. But that leads into some of our future points. So this is the variance that I was just referring to. And then the confidence interval. This is important. This tells you how confident you are in this as your future potential. A lot of people, when we're talking online or when we're talking to other people, we like to sound more confident than we might actually be. Be honest here. How confident are you in this? Because literally, quite literally, your your future depends on it. So now we understand our current state. Let's talk about a roadmap. So what this is, I'm literally going to walk you through an example. So let's say that we want to retire in 10 years. Let's say that we want $200,000 per year. This is more of like a mid-fire / lean fire if you're in a high cost of living city, but this can be adjusted to whatever you want. I'm just using numbers. So that's why these are like 10, 200, 200, 1,000. These are very easy for you to adjust to your current scenario. So let's say we want $200,000 per year post taxes. Our current net worth is $200,000 and your savings rate is $1,000 a month. I will tell you right out of the gate, that's way too low of a savings rate, but I'm just throwing something out there based on these numbers at least. Okay, so let's take a look at this scenario. Let's say that you're a trader with at least 5 years of experience, and in those 5 years, you're averaging your compound annual growth rate is around 20% per year. It means you're doing great. So this is the growth phase of our account, and then there's a maintenance phase. The reason why I differentiate between these two is because I do not personally want to have to maintain essentially my top line performance into perpetuity in order to live off of it. It's a very stressful way to do things. So the way that I think about it is we have a growth phase where we're more aggressive, more on top of it, but then we ease off the gas once we start getting closer to our metric so that we can actually chill the fuck out a little bit, enjoy the stuff that we're working on. So think of it this way. Growth phase is what gets you to your maintenance phase. Maintenance phase is supposed to be a little bit easier and more reliable for you to hit. All right, so back over to this. As you can see, at a 20% growth rate with this information, you're going to have 1.55 million in 10 years. Does this get you to your 10% at 10% maintenance? Does this get you to your $200,000? No, it gets you to $150,000. So we are short. This is not what we're looking for. So in this case, we have to figure out how to fix this thing because we want to make sure that we are, again, on target. So in this case, we have 3 things that we could take a look at, and they're right here. We can look at our savings rate. We can look at the time frame. We can look at our rate of return. And my overall way to approach this is to use all of them. You don't have to just pick one. I certainly wouldn't if it were me. So let's talk about how we can use these different levers. If we change our savings rate, if we're able to increase our savings rate from $1,000 to $2,500 per month, that gets you to your 2 million, everything else being the same, ceteris paribus. Or you can look at the time frame. If we instead keep the same performance, but instead of this 10 years to retire, we move to 12 years. That gets you to 2.26 million. You've met your mark. Or you can play with your return. So let's say if you can go from 20% return to 23% return, that gets you to 1.95 million again in this time frame. Now, really important note, this is all pre-tax. A lot of this will depend on the rest of your tax footprint, but the point I'm showing you is based on these 3 inputs, you will affect the outcome up here, which is exactly what we're trying to do. So think of what of these you can adjust and how aggressively you can adjust it. Maybe instead of going from 1K savings, you go to 2K, but then you go from 10 years to 11 years. Maybe that's fine for you. There's a million different ways you can do this, but it's all going to be based on your current performance, what you're able to maintain into perpetuity, and then how much slack you're giving yourself in terms of your time frame. All right, I want to talk now about some of the best practices. You got to start with what you have. What this means is most people, they are scared to start even the conversation of this because they don't know these variables. They haven't thought about it. They don't even know where to start. We're actually having this dialogue in my free Outlier Discord right now. So you can hop in there. The link is in the show notes below. Like I said, it's free, but this is an important thing is just start with something, because just like a trading plan, just like a trading log, if you start the process of writing this stuff down, you will start to at least get something going, and then you can move it forward from there. So just start with what you have. Think about your current savings. That's fine. And then move from there. This is, I cannot overemphasize this. You have to be honest with yourself when you're looking at these things. There's probably going to be some stuff you're not comfortable with, because to be completely honest, this is why most people don't do it, is because they don't like the answer that they think they're going to see. AKA, if you looked at all that and you're like, damn, I'm going to have to do this for 30 years. Yeah, that sucks. But the only way to affect it is to acknowledge it exists and then do something about it. So you got to be honest. When we're talking about these different return potentials, in this scenario, it is extremely important to be conservative. I cannot overemphasize that. So if you think you could scrape by, maybe, taking the bike to work a few weeks instead of, driving to get you to a higher savings rate, maybe that's not super conservative and highly fallible. Be conservative in your numbers and be realistic. So this is probably one of the next most slept on aspects here, which is is once we've defined what we're trying to do, is to break this out into our tracking metrics, because we have our 10-year goal. That's what we just created. So then if we think logically, that means 5 years down the line, we should be halfway to that goal. So what does that mean? It means each year, each month, we need to be in pursuit of this 5-year and this 10-year goal, which if we did a good job planning them conservatively, we should be ahead of pace typically, which is good. That's what we want, because guess what? Life is going to happen. Shit is going to happen that's going to set you back. That's how it goes. So think about these different metrics that support those longer term metrics. Early on, as I mentioned before, this is your biggest lever. This is the easiest thing you could do, is save money. So instead of trying to move from a 20% return to a 23% return, which might be really fucking hard, an easier thing would be just save an extra $200 a month. And those kinds of changes are massive. So think about saving first, but you can only save so much. You can only cut so many expenses. What I mean by saving, increasing your savings margins. You can only cut so many expenses. You still need to eat. You still need to do what you got to do. So this is immediately your second priority once you get to a good savings place, is more income, whether it's side hustles, whether it's creating another side business, whatever you have to do to start creating more income, it's got to happen, and it's got to happen as fast as humanly possible, because this increases our savings margins. That's the whole point. And then the last thing here, OODA loop and CPI. OODA loop sounds really weird. This is actually from a book that a lot of Marine officers have to read, and it's a decision cycle of a fighter pilot. And you can look it up, but essentially what I'm referring to here is this is observe, orient, decide, act. This means this is a perpetual review of where you currently are in this process and then what needs to happen to get you there. Because let's say for a couple months you're slightly behind pace, but at the end of the year you're above pace. Well, that's great. Maybe you can ease down your return targets. Maybe you can ease some of the savings so that you can spend and enjoy now a little more, or maybe you can accelerate your time frame. But this is a perpetually adjusted process. And then the last thing here is CPI, continual process or continuous process improvement. It's exactly what it sounds like. These little things, none of this is complex. This is why I like investing so much, is because a Neanderthal like myself can do this. All you have to do is create a little bit of planning, some metrics around that ultimate goal, and then go for it. But one of the worst possible things you could do is just think that life is going to magic you there, because you're going to look back after 20 years and you're going to say, what the fuck just happened? And guess what? Those 20 years are going to be your best possible compounding years that exist. So if this video is helpful, like, share it with other people that need to do this, subscribe, be an outlier. I'll see you guys later.